years ago, I discovered that the stock market tends to echo the movements of crude oil prices about 10 years later. What I'm showing in this chart is a plot. These are both logarithmic scale plots. Crude oil is on the top, and it's shifted forward by 10 years and compared to the Dow Jones Industrial Average. And you can see that every one of the movements, every one of the major movements anyway, in crude oil gets echoed about 10 years later as a similar movement in the stock market. Almost 10 years ago, crude oil prices started going through an unpleasant decline. OPEC had been defending crude oil prices against the dilution of prices due to fracking and the shale boom, and they finally decided to give up, and we saw a big decline starting in 2014. Well, you add 10 years to 2014, and we get to 2024, and that's where we are right now. Zooming in a little bit, we see that not the crest, but the ledge that we fell off of in crude oil prices. That was in June of 2014. So if it works out exactly 10 years later, then we would be thinking June of 2024. You don't necessarily take this literally for the magnitude of it, but it's pretty good about the timing of the turns. So I wouldn't necessarily expect that the stock market has to have a decline as big in magnitude as what the crude oil shows over the next couple of years, but it should be an unpleasant time starting this summer and lasting into early 2026 to echo the oil price decline.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stock markets have had a massive run since November of last year, and all the major indices, the S&P 500, the Dow, and the NASDAQ, have hit all-time highs recently. U.S. GDP growth for the current quarter is currently predicted to be 3.6%. Global economic growth, as measured by PMIs, has turned positive for the first time in 2 years. The official unemployment rate remains below 4%, and the most important stock to the markets, Nvidia, just beat expectations on both earnings and revenues. So it's unsurprising the bulls are feeling large and in charge right now. Talk of hitting S&P 6,000 later this year is getting louder. Is that likely? In heady times like these, turning to the data and navigating by what it's telling us is often highly useful, which is why we're fortunate to have one of the best technical analysts in the industry, Tom McClellan, joining us today to share his latest interpretation of the current market action. Tom, thanks so much for joining us.
It's always fun to be with you, Adam.
Thanks, Tom. I appreciate you saying that because it was decidedly not fun for you when you joined our spring conference back in March, because you were post-surgery, but in the throes of a terrible cold, and you were just an amazing soldier to come on and still present through all that. So I owe you a huge amount of thanks for that, as do the folks who went to the conference. I got so many comments, Tom, about how impressed and grateful folks were. One, because you put together an amazing amount of slides, really one of the highlights of the conference. But the fact that you did it under such bad health conditions really just speaks a lot to your character.
Yeah, I think I went through an entire bag of cough drops during that presentation, but got through it and happy now. So I should be good for the rest of the year now that I've built up all those immunities.
I hope so. I hope so for at least the rest of the year. But again, huge thanks. Huge thanks again for coming on today. I want to thank you in advance. We just talked about the possibility that you hopefully may be able to participate in the upcoming conference in the fall. I know we still need to confirm whether that indeed works for your calendar or not, but it seems like you're sort of interested and open to that. And I'm just saying that here because I know I'm going to get a ton of questions in the comment section if I didn't actually let people know that I've been extended the invite to you. So hopefully we can lock that down. As a reminder, folks, much more detail about that conference will be coming over the next couple months, but we have locked the date in. It's Saturday, October 18th. And then I also want to quickly thank you, Tom, for being the first contributor to the new Macro Pass service that we've been offering to our premium Substack subscribers. The new service has been really well received. Folks are really enjoying it, but the fact that we're able to kick it off with you and with your excellent monthly report that you'd put out was just a great way to launch this thing, a great inaugural boost to the program. So thank you again for being willing to do that.
Sure. And well, by October, if my long-term models are correct, we should have a whole lot more interesting things to talk about, which is not necessarily a good thing.
All right. Well, look, that's a great segue then into today's discussion. You very kindly did the work in advance and put together a series of charts that I just want to, as quickly as possible, get you started on, because I know that's what the audience is going to want most. Very quickly, just to sort of help them orient to your general point of view right now. What's your current assessment of the global economy and financial markets?
Well, one of my favorite sayings is that gobs of breath is a good thing. We're seeing new highs, not just in the price indices, but also in the New York Stock Exchange advanced decline line, which is probably my favorite liquidity indicator. When you've got enough money sloshing around that the majority of stocks can find some of it and can go higher, that is a condition which tends to persist for a while. If you instead saw, which we're not seeing, but if you instead saw higher highs in the S&P 500 and a lower high in the advanced decline line, that would be a big problem. I'm looking for that, watching for that, not seeing it yet, but right now we have some immunity from a decline, which I'll be talking about in a few minutes.
Okay. All right. So I sort of take from that right now, fair weather, calm seas, but you're scanning the horizon to see, if the potential initial signs of this approaching storm, are coming. But right now, clear sailing.
Clear sailing with the ordinary garden variety dips that come along every once in a while anyway. We're
Okay.
not immune from that. The ordinary garden variety pullbacks that get everybody afraid and thinking the sky is falling, which is a useful thing. Once you get everybody asking how far down can the market go, you're down, you're close to the bottom. Right now, everybody's asking how far can the market go up, and that's kind of the indication of the opposite condition, where if everybody's optimistic, it's time to be worried.
Okay. All right. So, we may be near sort of a sentiment extreme of, everybody being on the everything is awesome side of the boat. But let me stop talking. Let's get to your slides if we can, and hopefully you can walk us through what you are monitoring most closely right now in the markets. Now I see it.
Okay. So you wanted to know what I'm seeing, and so I just put together a few of the charts that are striking to me and interesting that I thought you and your viewers would like to see. But before I get to that, I wanted to share that I just was recently in Mexico City. That was after I got over being sick. And it had been a dream of me and my wife to go see Mexico City and see the original site where the Cortez and the conquistadors built this city on a former lake and conquered the Aztecs, and learn all that history because we'd never done that. Got to see the pyramids at Teotihuacan. But the funny thing about building a classical European style city with big stone buildings on top of a marshy lake bed is that's not really the best kind of urban planning. This is a picture I took of one of the lesser cathedrals that's near the city center. It's not the big cathedral that's in the Zocalo. Oh, and by the way, if you saw the movie Spectre with James Bond, the Zocalo actually was not destroyed. It's still there. So that's good news if in case you're going.
Oh,
but this was one of the cathedrals nearby, and it shows some of the signs that a lot of the buildings in that area show. I want you to focus on this chandelier right here. The chandelier is hung from the exact center of the ceiling, and I took this picture in the exact center of the main aisle through the sanctuary. And you notice that the chandelier is not hanging over the center of the aisle. And if you look a little bit, like the walls are not kind of straight, and that's kind of what happens when you build on marshy, swampy lake bottom land with big, heavy stones, that they start sinking in and things shift. And so you kind of have to tilt your head to think how the builders of this might have intended everything to be nice and plumb and straight, but they are not now. And you can even see the balcony in the back of the narthex there is looking a little bit off. But they strive to continue on with life in Mexico City, because that's just part of the deal there. Learning to see things a little bit tilted has benefited me in my market analysis, and we'll come to that as we go through this presentation. One of the things that I'm looking for immediately is an end to this big, long uptrend. And the reason for expecting that is that years ago, I discovered that the stock market tends to echo the movements of crude oil prices about 10 years later. What I'm showing in this chart is a plot. These are both logarithmic scale plots. Crude oil is on the top, and it's shifted forward by 10 years and compared to the Dow Jones Industrial Average. And you can see that every one of the movements, every one of the major movements anyway, in crude oil gets echoed about 10 years later as a similar movement in the stock market. Now, the magnitude may not be exactly the same, and the timing may not exactly be 10.0 years. It can be off by a month or two, and that's normal. But generally speaking, the movements of crude oil tend to show up again later in the stock market. And that's important because almost 10 years ago, crude oil prices started going through an unpleasant decline. OPEC had been defending crude oil prices against the dilution of prices due to fracking and the shale boom, and they finally decided to give up, and we saw a big decline starting in 2014. Well, you add 10 years to 2014, and we get to 2024, and that's where we are right now. Zooming in a little bit, we see that not the crest, but the ledge that we fell off of in crude oil prices. That was in June of 2014. So if it works out exactly 10 years later, then we would be thinking June of 2024. But it doesn't always work out exactly 10 years later. So for example, this bottom in crude oil prices in November of 1998, that got echoed as a bottom in the stock market in March of 2009. So not exactly 10 years, but the decline was there, the bottom was there, and the rebound was there, all as crude oil had predicted. Sometimes we get an exogenous event like the Iraq War in 1990 and 91, which caused crude oil prices to double. We didn't really echo that double because it was an exogenous event that wasn't really a market event. Similarly, the magnitude of the big commodities bubble in 2008, which crashed down to January 2009 in crude oil prices, that saw its echo in the stock market, but in much more miniature form and off by just 1 month from the ideal bottom date. So you don't necessarily take this literally for the magnitude of it, but it's pretty good about the timing of the turns. So I wouldn't necessarily expect that the stock market has to have a decline as big in magnitude as what crude oil shows over the next couple of years, but it should be an unpleasant time starting this summer and lasting into early 2026 to echo the oil price decline. Now, having said that, we're not seeing any signs that that's looming because we're still seeing strong breadth numbers. Advanced decline line is strong. And so we're not seeing the setup for a big decline, but we're looking for the signs of that. Now, as I mentioned that,
and sorry, real quick, just head back to that previous. So we've spent a lot of time talking about this spooky correlation between oil prices and the stock indices, in your previous appearances, particularly during our conferences. And so I just find it so fascinating, but you can't deny the correlation in these charts, both over the past century and even just the past couple of decades here. So to go back to our nautical analogy here, you're out on the ship, you're seeing, fair weather and calm seas, but your captain's log says, hey, when we've been in this place, before, there's been a big hurricane that comes around this time of year. And so that's why you're scanning the horizons here saying, if this correlation holds, yeah, it looks like, the summer/fall could be pretty stormy.
I'm not sure if a nautical chart is the best analogy or a weather radar. There's something coming. I don't really know why this works, but it's been working since the 1890s. And so at some point you stop wondering about why and you accept that, yeah, it must be working, even if I don't understand why. I really don't understand why gravity works or why the lights come on when I flip the switch, but I don't have to understand those things in order to rely on them. I don't rely on this model totally, because it's not perfect. It's merely very good. And so it won't tell you everything that you need to know. It's not the Holy Grail, but it's pretty good. Now,
right, well, I remember talking with you about this back in, I think, the fall of 2023. And you had said, hey, if this correlation holds up, June 2024, that might start getting pretty interesting. I just got a flag, we're now weeks away from June. So again, as you said, it doesn't necessarily arrive on 10.0 years. Maybe it's off by a couple months or a quarter or whatever. But now we're here. So we're going to find out whether this correlation really holds this time or not.
And the point is that I'm not predicting a June crash. That's exactly not the point. June is when things should start to get bad. That's the start point of things getting bad. That's not the climax of things getting bad. The climax is not due till January of 2026. But what I can say is that whoever gets elected in November is going to get blamed for this decline, which is already baked in. Somehow crude oil knows what the money flows are going to be 10 years ahead of time that are going to affect stocks. I don't know how crude oil knows that. It doesn't matter how crude oil knows that if it works well enough to have to rely on. But
All right.
we're not seeing the signs yet. And I mentioned the strong advanced decline statistics. And just to kind of put into perspective why that's important, here is a comparison. This is the Dow Industrials on top, and this is the cumulative daily advanced decline line for the NYSE. And this is I just to pick this time window because it's very useful for instruction. We saw huge divergences at the 2000 top and at the 2007 top, where prices were still making higher highs, but the advanced decline line was making lower highs. That's a huge bearish divergence, a huge message of trouble. And when you see that, you want to start figuring out what you're going to sell and how you're going to protect yourself, and maybe even how you're going to profit from the decline that might come.
All right,
We are
I'm gonna murder this analogy, but this divergence here is sort of like the falling barometer, right? In our sailing analogy. Like it's telling you a change is underway. You're not necessarily seeing, the physical signs of it yet, but you're like, okay, this falling barometer here is telling me that there's a new pressure system coming in that's going to change the game.
Or you're a coal miner in Newcastle 200 years ago, and the canaries start falling over dead, and you look and say, well, the coal miners are still doing fine. Everything must be okay. No, you need to watch the canaries, and the 80 line is the canary. What we're seeing right now is the Dow Jones Industrial Average is making new higher highs, just ticked above 40,000. The advanced decline line is making new all-time highs. So no divergence now. We had a smaller divergence, not a catastrophic one, back in 2022. That said there's still problems and weakness, but then we saw some bullish behavior. This was a bullish divergence in the advanced decline line that failed, and we still got a little bit of decline. We saw another little advanced decline line divergence. And generally speaking, a little divergence leads to a little problem. A big divergence leads to big problems. Earlier this year, back in January, we saw a beginning of a divergence, but it failed and it got rehabilitated because the advanced decline line started making higher highs. That happens sometimes when you have a divergence. We have no divergence right now. Things are looking great. Things are looking not worrisome from a liquidity standpoint. Generally speaking, liquidity problems are the worst kind of problems. You can have other problems. You can have news problems. You can have earnings reports. You can have the Fed announcing something. But when liquidity is great, the market can get past all those other minor annoyances. When liquidity problems start, that's when you have a really long-term problem, and it's much harder to solve liquidity problems. We don't have that yet.
And sorry to interrupt, but if there's a short answer to this, what do you monitor to see if there's a developing liquidity problem?
This very advanced decline line. I watch the breadth statistics every day. We publish it in our daily edition. We watch to see how they're doing. As long as breadth is strong, that means liquidity is available. And in fact, I did a study on this years ago. I wanted to know if you have a new high in the advanced decline line, how protected are you? And so what I did is I looked at not an all-time new high, but a 3-year high in the New York Stock Exchange advanced decline line. Then counting forward from that, what is the worst 3-month forward drawdown in the S&P 500? And most of the time, these bars only go down to about minus 10% or less. So these are all showing you what's the drawdown after you had a new high in the advanced decline line. The big exceptions you're going to see at the end of QE1 back in May of 2010, we got the flash crash, which broke this 10% line. At the end of QE2, we had a 19% decline in July of 2011, which broke this 10% rule. COVID-19 broke this 10% rule. Outside of conditions like that, if you see a new high in the advanced decline line, you can still have an ordinary garden variety correction, but it tends to be limited in magnitude to 10% or less. Now, don't get me started on 10% equals a correction. That's an old canard that people need to stop relying on. But generally speaking, if we can have an ordinary pullback at any time, but when you have a new high in the advanced decline line, you are somewhat immunized from having the worst sorts of declines, unless the Fed puts a thumb on the scale or the government shuts down. Then all bets are off. And I focused on the New York Stock Exchange advanced decline line. This is the NASDAQ advanced decline line. Don't ever use this. Don't. It's bad. It has a terribly bearish bias. And you can see the NASDAQ making higher highs, and this is making lower highs all the time. It's making lower highs. It's still making lower highs. It's always in a downtrend. In fact, a trivia question I like to do in presentations is to ask, when was the last time that the NASDAQ's advanced decline line made a new all-time high? And it's a trick question because it has never made a new all-time high. It started going down from the beginning of the data in 1972, and it's never gone back there. It always has a bearish bias, and that's because the listing standards on the NASDAQ are a lot easier. So if you are owning a company that's going to IPO at $50 a share and then go broke, you're more likely to do that on the NASDAQ. And every day that your stock spends going from $50 to $0, it's going to be contributing to the number of declines. And so that's why you see such a persistent bearish bias in the NASDAQ advanced decline line. So yes, it's true that there's a bearish divergence in the NASDAQ advanced decline line versus prices. Yes, that's true, but that's never mattered. And so don't rely on it. Don't listen to anybody who quotes this and says that's an important divergence, because that proves that that guy doesn't know what he's talking about. The NASDAQ advanced decline line can be used. The data can be useful if you look at the acceleration that takes place in it on a shorter term basis. And that's what the McClellan oscillator does, the indicator that my parents created. So that way it can be useful, but on a cumulative basis, it is not useful. And so don't look at it.
Fascinating.
In fact, here's that long-term chart. This only goes back to 1996. The NASDAQ was created in 71. The data on trading, and it began in 1972 in Barron's, and my parents have been collecting it since then. It's just a persistently bearish bias all the time. And so it's just, if it's always bearish all the time, it's not a reliable indication that you can draw much from. One thing that we have come into recently that is very useful is we look at the advanced decline statistics on corporate high yield bonds. And these are not stocks, these are bonds that are categorized by FINRA in the high yield category. They look at investment grade bonds and high yield bonds, and I'm not sure whose ratings that they use to make the division. These bonds tend to trade a whole lot more like stocks than like treasury bonds. And they draw from the same liquidity pool that stocks draw from. So when you see these junk bonds doing well, that's a sign that liquidity is plentiful. When you see back at the end of 2021, you see a big bearish divergence between these high yield bonds and prices. That's a big warning sign that there's trouble. We saw continued bearish divergence in 2023, even though the S&P 500 seemed to be doing well, and that led to the ugliness that we experienced last autumn. Right now, this is at a new all-time high, or not, excuse me, not new all-time high, but new recovery high for going on here. So the fact that it's lower than back in 2021, that doesn't really matter. What matters is more the local comparison, and the fact that it's higher than this last high, that's bullish. I'm watching though, because these bonds tend to be the early warning. These are the real canaries, because they are the most vulnerable to liquidity. And so they'll show problems with liquidity first, before even the New York Stock Exchange advanced decline data. Right now, they're not showing a problem, but I'm watching it and waiting for the message to come if it shows a problem.
All right. So again, we have no idea if it's going to hold this time or not, but if the 10-year forward oil data that correlation does hold this time around, sounds like you would expect to see this corporate high yield bond advanced decline line starting to trend down while stocks continue to move up, right? That's the divergence you're looking for. You'd imagine you would see the divergence here in the high yield bonds advanced decline line before you see it in the New York Stock advanced decline line.
Exactly
and when
right.
you see it in the New York Stock advanced decline line, you would probably say, all right, we got a trend here we got to start really paying close attention to.
And the market doesn't always give us what we want. You know, you look for bad signs, and sometimes you'll see a bad sign in one indicator, but not in another indicator. You don't see these classic historic examples of divergences everywhere like we saw in 2007. You don't get that all the time. And so then you have to grapple with, oh, what does it mean? We got a divergence here, but we don't have a divergence there. What do we do with that? And that's what we have to spend a lot of time doing, because the market doesn't make it easy, but it's still important to watch these things. This would be the first place I would expect trouble to show up, and I would expect it to get confirmed in the New York Stock Exchange advanced decline line. I'd expect emerging market stocks to start suffering too, because they also are very vulnerable to poor liquidity conditions. They're not doing bad yet, so we're not seeing any of the signs yet that we would expect that real trouble is coming. But I'm watching.
All right.
Well, this is the slide I shared last time, and it really, really matters a lot. There's only two fundamentals that matter for the overall stock market. First is how much money is there, and the second is how much does that money want to be invested. Now, the secret footnote for this is, what is money? And that turns out to be a much harder question to answer, because there's a lot of things that act like money that tend to push the market around, and I want to go through a few of them with you. One of the big mysteries of the last 2 years is why this correlation broke. The black line is the S&P 500. The green line is the Fed's balance sheet. It's total treasuries and mortgage-backed securities held by the Fed. And we've seen that every time you have QE, you rally the market. Every time you stop doing QE, you get a flash crash or a big decline. QE2, big rally for the market. You stopped doing it, and you had a 19% drop. QE3 was enormously bullish. You stopped doing it, the market went sideways. When we had quantitative tightening in 2018 and 19, big rocky time for the stock market. We had QE4 because of COVID, terrifically bullish time for the stock market. And we've now been in the third ever quantitative tightening, which was bad for a while, but then it stopped being bad. Like, how come if the Fed is reducing the money supply by doing this quantitative tightening, why is the market still able to rally? Where is the other kind of money coming from? And this was, I was struck by a presentation by Pento that you did with, what was his first name? Jim Pento?
Michael Pento.
Michael Pento, talking about repurchase agreements and reverse repurchase agreements. And this is a bigger deal than I've ever known. And I was appreciative of getting to see his insights about this. This is the definitions from the New York Fed website. So repos are the Fed pumping money into the banking system. A reverse repo is the Fed taking money out. Basically, a bank deposits collateral with the Fed and gets treasuries out of the Fed in response. And so a reverse repo takes money out of the availability to do things, important things like lift up stock prices. And so these are repo agreements, not the reverse repo. And the Fed hasn't been doing these for a long time, but they used to do that a lot back in the 2000s. They did a lot of repurchase agreements. They did a bunch of them during COVID when things were really crazy. But this is what repurchase agreements look like. And not surprisingly, they spike up in times of crisis, like the Y2K crisis or 9/11. But generally speaking, they used to not do very much, except that in these little movements, there used to be a lot of impact on liquidity. This is back in 1999 to 2003. And you can see that when the Fed was shrinking its repos, that was bearish for stocks, and it was increasing its repos. That was bullish for stocks, and it was increasing slightly. That was also bullish for stocks. Here's up through 2009. They tried to do a bunch more repos in 2008 because they realized that there were problems. But as soon as we got to September, the Fed pulled the chair away and left Lehman Brothers hanging, and we crashed the stock market because the Fed decided to yank all this liquidity out of the market. For whatever reason they decided that. I don't know what was going on in their brains, but it sure didn't help anything. They also were doing quantitative tightening for the first time ever, and it had the predictable effect of pulling stock prices down. So the Fed really has a big fat thumb on the scale when it does these repos, which it hasn't been doing at all lately because it's been doing reverse repos. And this is what the overnight reverse repurchase agreements plot looks like. It started out nothing back in 2021, started rising while QE4 was going on. And so, like that article said, reverse repurchase agreements take money away. But when you're pumping in $1 trillion a month of quantitative easing, it doesn't matter that you're taking money away through reverse repurchase agreements. It doesn't matter until quantitative tightening begins. And so when we had in early 22, we had both reverse repos increasing and quantitative tightening beginning. Not surprisingly, we had a big decline. And the decline that we saw from the peak in reverse repos until now has coincided with a bullish period for the stock market. The worry about this one liquidity factor is that they are down from 2.5 trillion down to only half a trillion now. And so there's not much more room for this to decline. And in fact, it's starting to curl upward as of the latest data, which means that liquidity is being compromised by what the Fed and what banks are doing. They're taking money and reserves out of the banking system and locking them up at the Fed. For as long as they do that, we create a little bit of a problem.
Sorry, go back to that chart just for a second. So just to help folks understand reverse repo, think of it almost like a sponge, right? It is soaking up liquidity when you're doing reverse repo. And so, it was sucking liquidity out of the market, or out of the system, starting in mid 2021. It then hit its maximum there in middle of 2022. And then they've been reducing it, which is basically putting liquidity back into the system, right?
Yeah.
And there's two things to potentially, if you like that trend, there's two things to be concerned about. One is, were it to continue, the sponge is almost out of water, right? So if they go all the way to zero, there's no more liquidity for the sponge to push back into the system. So kind of party's over. Or
unless it goes below zero and we get into actual repos instead of reverse repos.
Right, exactly. So exactly, they then have to decide to do actual repos, or the sponge starts sucking water back up again, and it starts draining liquidity from the system. And who knows? It's way too early to really tell. But as you said, that last wiggle there at the end looks like the sponge is actually starting to potentially grow again.
Yeah. And you use the word liquidity, which is the right word, and it's a horrible word because it's just the squishiest word ever. There's no units to measure liquidity. We can't detect it. All we can do, it's like the wind. You can't see the wind. All you can see is the effect of the wind by lifting a windsock or blowing dust around or bending the trees. So you know that there's wind out there. Liquidity is very much like that. You see it based on what it does to things. So when stocks start suffering, or when liquidity sensitive issues start suffering, that's the windsock telling you, oh, the wind's blowing, we better pay attention. So hearing Michael Penno talk about this and led me to do my own research on it and to look at this further. And that really helped solve the mystery that I started out with, talking about the break in correlation. This is a variation on that chart I showed earlier about the green line is the Fed assets. But what I did is I subtracted the overnight reverse repurchase agreements. And now you see a much better correlation to what is happening in stock prices. But you see that the quantitative tightening of QT3 is still going on, and the reverse repos are not canceling that out. So this is starting to curl over. It hasn't not yet had an effect on the stock market yet, but it could. But I was satisfied to at least get a solution to that mystery of where did that correlation go? It was working so nicely, and the reverse repos really help explain that. So if your viewers take nothing else, they should start watching. You can look at the Fed's Fred database, the St. Louis Fed, and they have data every day on the value of the reverse repos.
All right. Well, look, I'm going to send when we publish this video, I'm going to send it to Michael and let him know that he inspired this analysis. I know it's going to really tickle him. So that's great. And I love the fact that you were watching the conference before your section, back in March, and you saw Michael's presentation and got the inspiration for this. I think I just love the confluence of all this. All right. So real quickly, if we look at your new index there, the green line, and it's beginning to roll over a little bit. So I know you're a markets analyst much more than you are a macro analyst, But do you think that that may be the reason why all of a sudden Powell was, saying, "Hey, we weren't talking about rate cuts, but now we are," and actually, just more recently said, "We're now really talking about reducing QT going forward," because he's a bit worried that QT is now winning out as the reverse repos get dry?
I don't know if he has this chart. Excuse me. I don't know if he has this chart, but he has some kind of awareness of what it's doing and perhaps an awareness of what's coming. There's no way to get inside Powell's head. There's also no way to use this chart as a market timing tool. But it's an explainer of why liquidity really, really matters and what the Fed is really, really doing to have their thumb on the scales of liquidity, such that, we can look at seasonality and we can look at the first 100 days and we can look at this sector versus that sector. What really matters, though, is whatever the Fed decides they want to do to the money supply and to liquidity, because that factor matters far more than anything else.
So one last question on this, and I know this may be out of your purview, but I just love your opinion. So it sort of seems like increasingly as we go along in this story, our central authorities are becoming more and more willing to intervene against natural market forces. And probably the biggest evolution of that in recent history was the massive amount of direct fiscal stimulus that was sent to people. But if it's as simple as liquidity goes up, markets go up, right? Well, why don't we just do more of this, right? Why don't we just switch to repos once the reverse repos dry and just do repos all day long? What
Keep the party going.
limiters exist in the system?
Government intervention and government control of markets is great as long as the members of the government are really good at their job. There's little historical evidence of that being true in the long run. And so if you are operating under the assumption that, well, the government's going to take care of us, it'll sort out any problems, history is not on your side in expecting that hypothesis to work out well. The Fed screwed things up in 2007, thinking that they knew better than the bond market and thinking that the yield curve inversion didn't matter. They seem to be thinking that now. We keep hearing that, oh, well, the yield curve inversion is another one of those failed signals of recession. But people don't understand that it takes 15 months for a yield curve inversion to work its way into the economy. So we are just now reaching the point of when a yield curve inversion matters. And keeping it inverted like they're doing now means that it's going to stay bad for the next 15 months. If the Fed were to disinvert the yield curve now, which they should, that would be helpful, but only 15 months from now. For the next 15 months, we have to endure the echo of keeping the yield curve inverted right now, and there's not much escaping that. You can try throwing money at that, but then we saw that throwing money at the problem during COVID caused inflation to spike up to 9%, and that's not necessarily a good thing. So manipulation can be useful in times of crisis, but when you start using manipulation all the time, it's like going away from organic gardening and going to strictly hydroponic gardening, where you have to control the moisture and the nutrients and the lighting all at the same time. It's great if you can control all those things, but governments show a tendency to not do that very well. And politicians who put their thumbs on the scale tend to do the worst kind of job of managing those kind of things. But that's really drifting off the topic of what the markets are going to do.
It is. But I appreciate it for a variety of reasons, and not the least of which is it sounds like you said that there's almost some sort of lag effect that we need to worry about here. You're laughing. You probably know, Tom. I keep reminding people that the lag effect acts with a lag, and it's not to be forgotten if it hasn't arrived yet. Yeah.
And it'll usually work at the point when people think, oh, it's not going to work anymore.
Right.
And that's when it starts coming. Shall we move on?
Please.
This is one of the ways that I've figured out to look at these data on reverse repos that I think is meaningful. This is looking at reverse repos only, not with quantitative easing or tightening mixed in, not with Fed assets, just reverse repos on their own. And I'm looking at a 5-day change. In other words, what is it today versus 5 days ago? And I invert it on the scale. So when reverse repos are going up, this has a negative reading. And then I did this just to help myself understand what the effect is on the stock market, because generally speaking, when you have reverse repos coming down, money's coming out of the Fed, and this indicator is positive, then you get a positive effect on the stock market. When you have them negative, like we have seen recently, then you get a negative effect on the stock market. However, you got to be aware that the end of the quarter, it always gets screwy. You get these big spikes with banks and the Fed doing weird things just on the last day of the quarter. So you got to discount when you see the end of the quarter effect, which we'll get to again at the end of June. So if you're going to build this indicator for yourself at home, and it's very easy, you can get the data from the St. Louis Fed website and track it every day. It'll do a 5-day change. Maybe a 4-day change is better. I don't know, but 5 days seems to work. Just know that end of the quarter, it gets screwy. Right now, as I'm speaking to you, before this airs on your channel, it's negative, but that could change by the time anybody sees this. M2 is another way of talking about what money is, but M2 needs to be understood in its own way. M2 is finally starting to curl back up again after shrinking. The way I like to look at M2 is to compare it to GDP. Because if the money supply is growing, that's fine as long as GDP is growing, and so that you have the same ratio of those things. If you imagine you had a certain amount of money and everybody's got some, so they're walking around with the same amount of money in their pocket. If you double the population, but you don't double the money supply, then suddenly everybody's got half as much money. So that's a problem. Same thing with GDP. The amount of money sloshing around to keep the GDP going matters. And so comparing M2 to GDP seems to be really useful. And it seems to be extra useful for telling us what the stock market's going to do. What I'm showing you in this chart is the M2 to GDP ratio is shifted forward by 12 months. And what we see is that when you get a big rise in the money supply versus GDP, then 12 months later, you get a big rise in the stock market. When you get a decline, though, that we saw in the mid 2000s, it doesn't necessarily translate into a decline in the stock market, at least not right away. What typically happens, and we're seeing this repeatedly, is you can see the stock market continuing to go up, even though this M2 to GDP ratio goes down, but there's a payback late in that cycle. And that payback tends to occur right as this starts to curl up again. And so when we saw QE1 starting in 2009 to 10, we got a big rise in M2, caused a big rise in the stock market. The stock market kept on going thanks to some more QE, but the payback came late in that cycle, right as this was starting to curl up. Same thing in the late 2010s. We saw a big rise, led to a rise in the stock market a year later. The stock market kept on going, even though this ratio was curling down, but there was that big payback. And QE and COVID helped a lot with that. We saw a big rise. We got a big rise in the stock market. Now M2 has been falling at the fastest rate ever in the history of gathering these data, which go back to 1959. But the stock market is still going higher again against this message M2. If this is the curling up point that we just saw at the February 2024 low for M2, then counting forward 12 months, you get to February of 2025 for a big payback moment, similar to COVID or similar to 2011 or similar to 2007. You get this payback right at the anniversary of that inflection point. And so M2 is kind of a weird thing. It used to be, though, that back in the 1960s and 70s, M2 was very closely correlated with stock price movements on a continuous basis, on an instantaneous basis, no lag time. And so that's why guys would gather around the Quotrec machine every week when the new M2 and M1 money supply measures were coming out, and they'd all watch to see what it was doing because it was such an important contemporaneous effect on stocks. That changed in the 80s and 90s. It went to about a 6-month lag. Now, for the last 20 years, it's been operating with a 12-month lag. I don't know why, but that's what I had to do to the data to make it make sense with the price data. If we ever get another round of QE and this M2 starts to GDP ratio starts going up again, we can expect that's going to have a huge positive effect on stock prices a year later. And we may be seeing it curling up now. It's too soon to tell. And the Fed is not very good about publishing the M2 data on a contemporaneous basis. They're lagged by about a month and a half with the reporting. But that's what we got to deal with.
All right, two questions here. So one, like your oil prediction of if that correlation holds, we should see some sort of downturn second half-ish of this year. This seems to be saying it's a different correlation, but it's delivering a similar message. If indeed this is the curl up part of the M2 to GDP ratio, maybe it's more of a first half in 2025 versus the second half of 2024, but still in the same general time range, correct?
Correct. And we don't know how this plot is going to turn out. I can only deal with the data that I have. So the Fed has not yet drawn this line out as far as I would like them to give us confirmation of oil's message. You're probably detecting my bias in all these charts that I like to get the answers ahead of time. Mm-hmm. And then I like to have confirming indicators telling me that, yes, those answers are correct. Right now, we have a lot of warning signs of trouble. We don't yet have the confirmation yet that trouble is arriving, but we see a lot of signs to expect trouble to come.
Okay.
What was the second question?
Second question is, the markets go against M2's message, and then once that ratio begins to curl up, you get payback, right?
A year later.
Pardon me?
A year later.
A year later, 12
after the curl up.
Yeah. I just noting here that it appears that when you have those alligator jaws opening up, when the markets and the M2 to GDP ratio are diverging, it seems to be greater than it's ever been in this series. Does that lead you to expect that the payback may be bigger than previous parts in the series because of that divergence, or can we not take that message from this?
Here's the problem. We only have good M2 data back to 1959. We just didn't calculate it before then. We have never, ever seen a decline this steep in M2. So I can't backtest it and say, well, based on all the past times when we've seen this, it means this. Well, I can't say that because we've never seen this before. You can hypothesize that it might be worse, but we don't have any examples to show us. And I tend to not focus on magnitudes of movements very much at all because it doesn't really help. So if I told you that there were two possibilities, the first possibility was a 20% stock market decline, and the second possibility is a 40% stock market decline. I don't know which of those two possibilities it is, but it's between one of those two possibilities. What would you do anything differently? Or would you say, I want to avoid both of those? Mm-hmm. So your actions are not going to be different based on which of those two choices it's going to be. And so I try to just get the direction right and the timing of the turns right, and I let the magnitudes take care of themselves.
Okay, thank you.
Moving on, I want to come back to this church and just say, if you want to see this church as it was intended, you have to kind of tilt your head to the side a little bit, and because it's not quite plumb, and that's kind of my approach to looking at these charts. Most people look at charts contemporaneously, but I like to find the secret hidden message. One of those ways that I have done this is I like to look at gold and interest rates. This is the Treasury Yield Index. It's a great way to look at long-term interest rates. It's the current yield to maturity on the most recently issued 30-year Treasury bond, whatever that is. And if you look at them on a contemporaneous basis, you'd say, well, they're pretty much inversely correlated. You got gold going up and you got yields going down. You got gold coming down, yields going up, pretty much inversely correlated. But it's not a very clean correlation. And so what I did by tinkering around with it, I found that if I shifted gold forward by about 20 and a half months, I get a much tighter correlation. And what that's saying is that gold's dance steps 20 and a half months before get echoed in bond yields, which is fascinating. How does gold know 20 and a half months in advance what bond yields are going to do? And I don't have a good answer. I also don't have a good answer for why sometimes bond yields go off the script. And you just get this weird movement that wasn't at all expected, but then they get back together. And you get a weird movement that wasn't expected, then they get back together for a while. And then right as you're counting on it to work again, you get this big weird deviation from the script, and then it gets back together. Right now, they're back together again. And so gold's leading indication is giving us good, clean reading on what should happen. Bond yields should be coming down to a bottom that's due in June, and then another bottom in July. And then we get a big up move in gold prices later this summer. excuse me, not in gold prices. We've already had the up move in gold prices. We get a big up move in bond yields later this summer. And when I say a up move in bond yields, that's a down move in bond prices. Now, notice that this chart doesn't include all of the history of gold because I chopped it off just so we could see it. Gold is right now up above 2,300. And so if that relationship remains in effect, then we got a lot higher later on, 20 and a half months from now, for bond yields to be going up. But with the expectation that as soon as you count on it to work, then you get another one of these big deviations from the script, which will last for a while, and then they get back together again. I don't know why that happens. And it really frustrates me when it does, because I get to counting on it and I'm hoping that it's going to work, and I develop my expectations, and then, whoa, crazy Ivan. What like from the movie Hunt for Red October,
yeah.
The Russian sub decides to turn the other way.
That is, again, just fascinating. So what's interesting about this is that it is for the next, 2 years-ish, seems to be predicting a secular increase in treasury yields.
And long-term treasury yields. Short-term end of the spectrum is totally controlled by whatever the Fed decides. They don't have as much influence over the long-term treasury yields. So long-term treasury bonds tend to follow what gold said they should do.
Okay,
But
so
20 and a half month lag time.
I would say one of the topics that I see the most divergence on in terms of the experts that come on this channel is what's going to happen both with inflation and interest rates from here. And, there are definitely those who think that rates, that inflation is going to come down, that, interest rates are going to come down along with it. There are some that think that, disinflation and deflation are going to take over, maybe even get into a recession or, real market, scary times in the markets, and the treasuries are going to receive the safety bid, right, pushing yields down. But this correlation doesn't seem to support that beyond just some episodic moments, correct?
Correct. And one of my best leading indicators for looking at inflation, which I did not bring for this presentation, is global average temperatures. In other words, global warming is good for bringing inflation down. If you have rising temperatures, you get lower inflation rates about 3 years later. And if you have it's crazy, but it's only been working for decades. And if you get cooling temperatures like Al Gore wants, then you get rising inflation and you get falling crop yields and you get other problems from cooling temperatures. So that data says that we should get falling inflation roughly for the next 3 years with a bunch of bumps and wiggles along the way. It's not going to go in a straight line. But if Congress keeps deficit spending and the Fed keeps trying to stimulate the stock market, then we're creating more money, and the price of anything is money per unit of stuff. And so if you keep the amount of stuff the same, but you increase the amount of money in the system, then the money to stuff ratio is going to go up, irrespective of what the temperature data says. So the temperature data will tell us what the plot will look like, but it won't tell us the value of how much extra inflation we're getting because of what Congress does. And that's the real shame. If we can get Congress to start balancing the budget and living within our means, then we can return to a much better economy. It'll be an unpleasant period to go through to get back to a regular economy. But generally speaking, higher inflation does all sorts of bad things. Higher inflation leads to rising unemployment about 2 years later. Higher inflation leads to rising crime rates about 1 year later. And so anybody thinking, oh, we need to get used to 2 or 3 or 4% inflation is criminal in my mind, and creating economic malpractice by advocating for that. We need to get back to the Fed's actual statutory target, which is 0% inflation. I'll put away my soapbox.
Which, and I know you posted about this on Twitter in the past. There's a divergence right now between their statutory target and their policy target of 2%, right?
That's true. The Fed has decided that its target is 2%. Congress decided in 1978 that the Fed's target is 0%, and everybody seems to be just ignoring that. And they decided, well, we'll do whatever we feel like. Congress doesn't call them on it. Economists don't call them on it. The press doesn't call them on it. I seem to be a lone voice in the wilderness saying, hey, let's look at the law and let's follow the law. And if the Fed doesn't like that law, they can go back to Congress and say, you need to give us a different target. But until they do that, until Congress gives them a different target, the Fed's job is to salute and say, yes, sir, and move on, or resign and protest. That's their two choices. And they're taking what's behind curtain number 3 and saying, we'll just ignore that.
All right. Well, we can all wish that some of the things that you just said, need to transpire in the end to get to a better system happen. But sadly, I'm not going to hold my breath.
But speaking of the Fed, our best indication of what the Fed should do is the 2-year Treasury note yield. And it is saying that the Fed needs to cut right now. Generally speaking, the 2-year knows ahead of time what the Fed is going to do. And the longer the Fed thinks it knows better and does something different, the worse problems it creates. So we saw back in 2006 and 7, it was a very good model. The Fed was raising rates like it should, but then they kept rates too high for too long, trying to quash the real estate bubble. And they didn't listen to the 2-year note yield, which is saying, we got problems here. And that led to because the Fed wasn't listening and they were asleep at the switch, that led to the Fed having to cut rates at the fastest rate ever. They didn't listen to when we had zero interest rate policy in the early 2010 teens. The 2-year was saying, we really should be a little higher than zero, but the Fed thought they knew better. And so we were stimulating the everything bubble. That all went badly when 2019 came along and the Fed realized they had to start doing QE again, although we were instructed not to call it QE. Right now, we're seeing the same sort of malfeasance by the Fed. They're keeping rates high, even though the 2-year says you ought to be down here almost a point lower. And when you see the 2-year start heading south fast, you know that the Fed cut is coming. We could get by with a lot less dramatic of a cut if the Fed would just wake up and listen to this. But so far, all the members of the FOMC have expensive economics PhDs, and they think that they know better than the bond market does. And so they just won't listen to that. But
So
I'll keep banging that drum.
Yeah, I've talked about this with a number of other experts on the channel, where this one to me just seems super clear, right? Like you just look at the past history of heading into these recessions and market corrections that have followed the exact same pattern, right? Where the Fed keeps rates too low for too long, it then hikes them, and then it hangs out, and then the wheels start coming off, and it scrambles to try to catch up, right? And in that process of scrambling, that's when the recession hits, and that's when jobs get lost and markets correct and all that stuff. And it seems very predictable at this time that we are repeating that history. Now the one difference I see at this point in time is, I think the Fed maybe is a little bit more aware of this, hopefully, by this time with the pattern, but they may feel that their hands are tied a little bit more because of inflation, right? Well, I don't think we didn't have inflation as high and as much of a problem in these previous times. Just general thoughts on that. I mean, again, I know you think that 2 years telling them they should be cutting now, irregardless, but is inflation more of a limiter this time than in previous ones?
Well, I'm not persuaded that the Fed really has that much control or effect on inflation. And so I reject the entire premise of your hypothesis. Sorry, Adam. They think they do. That's their operating premise. That's what every economics PhD thinks. That's what you get taught in economics courses in college. Everyone thinks so, so it must be true. But there's very little evidence to support that hypothesis, especially when we see that the movements in the inflation rate are programmed in 3 years ahead of time by what global temperatures do. The Fed thinks that it's in control, and it's really not. But when they have an inflationary problem, thinking that interest rates can solve it is first of all, there's no data to really support that, and second of all, it's not from a lack of interest rates that we're having the inflation problem. It's a lack of fiscal discipline. So
yeah,
what the Fed chairman needs to do is, and he hates to do this, and he resists doing this, and I understand all his reasons, but Powell needs to go to Congress and say, look, I can't achieve the goal you've given me. If you keep overspending, you need to get your acting together and stop having these fiscal deficits, and then we won't have this inflation problem. But he doesn't want to do that, and so he tries to solve the problem using means that are unrelated to the actual problem.
Got it. Got it. Yeah, no, totally agree. And I've been mentioning this for quarters and quarters now, but that the Fed is jamming on the brakes while the fiscal side is jamming on the accelerator, right? And
Yeah.
what do you get when you do that? Eventually, a burned out seized engine, right? So it seems like that may be where we're headed.
And I have had a burned out seized engine, and it's not as much fun as it sounds.
All right. So sorry, let me let you bring the slides home here.
So bottom line, we're seeing gobs of breath, and that's bullish for as long as it continues. The stock market is not driven by earnings, no matter what they tell you on CNBC, but by liquidity and how much money is thrown around at the market. The money supply gets affected a little bit by mood and by sentiment, and so that's why sentiment indicators work, and people get frothy and they get pessimistic, and that bends it a little bit. But what really drives things is how much money there is. And so, if you want to know what the stock market's going to do, watch the money and watch what the second half is going to bring. Oil's message is terribly bearish. We'll see if it's going to be right. But right now, that message is saying ugly times ahead. And we got an election which could spice that up a little bit. Right now, the VIX futures for October of 2024 are higher than the VIX futures for November and December, as though the VIX futures market is thinking that there could be some turmoil in October, just on the head of the election. Last point, the Fed needs to cut rates now. They need to do the right thing, even though it goes against what they think they know. They need to listen to the bond market and do the right thing.
All right. So just keep this slide up just for a second. So you're a technical analyst. You look at the markets. You see all these correlations and try to predict where they're going. You're not necessarily a stock picker. But given this outlook, what's your general sentiment, from an investor standpoint? Is it still time to be dancing while the music's playing, but just keeping an eye on the door, meaning keeping an eye on your indicators, and when you start to see those divergences, that's when you want to start taking chips off the table, beginning to become a little more defensive? Or do you think, no, it's the time for defense is now, get out of the pool, or something else?
It depends on who you are. And if you're a 10-year investor, I'd wait. I wouldn't plow the money in now. Collect the 5% you're getting in your money market and enjoy it, and there'll be a better time to make your 10-year investment entry point. If you're already in, I wouldn't jump out now, because the advanced decline data is saying that there's no risk of a great decline yet. We can have an ordinary garden variety decline, which we can have at any time, but it's not time to panic yet. But that time is getting really, really close. If you're a trader, then forget anything I just said, because trade the noise and have a good time with that. I think that there's going to be a lot more opportunities for market timers. Anybody who grew up trading in the 1980s and 90s was told, forget market timing, buy and hold will save you all the time. It was amazing. In 2008, I used to be on the board of the old Market Technicians Association on their finance committee, and we saw the data on memberships and memberships in the Market Technicians Association, and now it's the CMT Association. Memberships in that organization grew a lot in 2008 because people realized, oh, the trend direction really does matter. I should learn how to pay attention to that. I think we're going to go through another episode like that over the next few years, where people realize that, oh, market timing and entry points do matter, and the trend does matter. Buy and hold doesn't work all the time. No matter what the Fed tries to do, there's only so much that they can do.
All right. Well, thanks so much for that, Tom. I always think of Einstein. Whenever I see your charts, I think of Einstein's comment on quantum physics, or quantum entanglement, right? I think he referred to it as spooky action at a distance. It's like, I don't understand it, I just know that it works, right? And some of your correlations just strike me like that. It's just spooky action, but the correlations have held for a long time. So it's going to be super interesting to see if they indeed hold, coming into the second half of this year. I really look forward, if it works out for you, to have you, back on in October, where we should really be in the thick of seeing the manifestation of those correlations, if they still hold. Obviously, if Anything happens between now and then where, you're all of a sudden seeing the indicators that you're looking for or whatnot, and you think, the action's really about to change, you've got an open invitation to come back on this channel and tell us about it if you want to. That'd be great. But in the interim, for folks that would like to look through your eyes and continue to track all these indicators, where can folks go to follow you and your work?
Go to our website, mcoscillator.com. That's a contraction of McClellan oscillator, the indicator that my parents created back in 1969. My dad is still doing great. He's 89 years old, going to be turning 90 in July. Still works with me every day. It's a huge privilege to get to work with him and learn from him and expand on the work that they did. My mother passed away back in 2003. But I still feel her spirit in the way that the numbers were created and calculated. Back when they did this in 1969, there were no computers to speak of. And so all the calculations that they did were all done by hand on ledgers. My mother was a math major and my dad was a business major, and it really took the two of them together to make it happen. Now we could have computers that answer questions for us instantaneously, but took a whole lot more work back then. We have a daily edition that comes out every day the market trades. We have a twice monthly newsletter. We also have a free weekly chart and focus series you can sign up for, no strings attached. We won't sell your email to anybody. We won't send you spam. It's just a way to get more people acquainted with our indicators and the way that we do analysis. Sign up right on our homepage for the free chart and focus. And if you want the good stuff, go to the subscriptions page.
All right. And I will say, having enjoyed your work, you don't leave anything on the table. Like, these reports are just jam-packed with data and information. And, Tom, you've got such a great way with words and making it all understandable to folks. That really comes across in your writing.
Well, I have the funnest job in the world. I get to poke around and solve puzzles and share that with people. And it's really, I've been doing this for 29 years. I don't have any plans to stop because there's still going to be puzzles, and the market brings us new stuff every day.
Well, thank goodness that we've got guys like you doing that. There's the whole Malcolm Gladwell, 10,000 hours. You're probably on your 50,000th hour or whatever at this point in time. And it's a huge help for those that want to see complexity made simple through your eyes. All right. So, and just wrapping things up here, I've got one last question for you, Tom, which is, what's a big lesson that you've learned across your very successful career that you think is worth sharing with the audience here? I'll give you 30 seconds to chew on that while I just do some quick housekeeping. Folks, if you'd like to, if you enjoyed this interview with Tom and would like to see him come back on the program as soon as he sees something notable in the markets, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder, we have cracked below the threshold where we now just have less than 10,000 subscribers to go until we hit the 100,000 subscriber milestone here on YouTube. And that's where you get the fancy plaque, and it helps with the YouTube algo picking up your work and all that. So if you can help us hit that milestone, if you're one of the 40, 50,000 people watching this video, please just take a second to hit that subscribe button. It'll really help us. Also, Tom just gave us a really interesting outlook of what may indeed happen with markets from here. It's one thing to see where the puck may be headed. It's another thing to figure out what your strategy is going to be given that direction. If you are not a already successful, experienced DIY investor, and you'd like potentially some help in figuring out how to navigate your wealth, given Tom's outlook and what may lie ahead, highly recommend that everyone who's not already very demonstratedly successful do-it-yourself investor work under the guidance of a good professional financial advisor, one who takes into account the macro issues that Tom and I talked about here. When you put that requirement on both being good professional and understanding all these macro issues, the universe of financial advisors actually gets pretty small. But if you've got one of them who's advising you, great, stick with them. But if you don't, you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. They'll be right in touch with you. All right, Tom, so we're back to you here. Whether it was a valued mentor that passed the knowledge along to you, or whether it was maybe a mistake you kept making until the school of hard knocks just beat it out of you, what's an important lesson you've learned along the path of your career?
Well, I was an Army officer before I started this career. I flew helicopters for 11 years, was studied aerospace engineering. So I was very engineering oriented, very formulaic. And so when I got into this business, the old timers kept talking about how you gotta get your head screwed on straight. You gotta be understanding what's happening with your emotions and not let them control you. And I thought, that's silly. I just need to have the right model. I need to have the right indicator, right formula. I've learned that those guys are right. And the mental anchoring, I think, is the term I would use for thinking about how you gotta let go of stuff. I bought my house in 1987. My wife and I we still have it. I've had it happen where I've lost in a trade more than the value of that house that I paid for in 1987. Now, inflation has changed the value of the house, but when your mental anchor is the cost of a house is this much, and you just lost that, and might have to tell my wife I just lost the value of our house in a trade, the original value. That starts to really weigh on you. But the fact that you just lost the value of your original house price today, that doesn't matter to what the stock market's going to do tomorrow. The stock market doesn't care what your entry point is. The stock market doesn't care about the profitability on your trade right now or the lack of profitability. It's going to do its own thing. And so whether your position is up or down doesn't matter. You have to let that go, and you have to look at what's happening and what's going to be happening, and put aside all the stuff that's in the past, because it doesn't matter. And that's really hard for us humans to do. Our brains hold on to those things. We get anchored by those things, and it's hard to let go. But you have to learn to do that, or the market's going to chew you up. And when you get into a negative emotional spiral, it can really blow up your portfolio if you keep arguing with the market. You got to let go of what happened in the past and focus on what's happening next. That would be what I would tell everybody.
Great point. I fairly often talk about why I respect the field of behavioral economics as much as I do, because we would all think we would make super rational decisions around stocks and money and all that stuff, and we end up making oftentimes really irrational decisions because we are human animals, and it's our wiring and emotions that really get in our way. And honestly, Tom, that's a big reason why I keep beating the drum about encouraging people to work with a good financial advisor, because like being a successful helicopter pilot, like it takes a lot of training to get your mental defenses against that, right? And a lot of people don't ever get to that stage. If you can, great. But if not, that's a role that a good financial advisor plays for you, is to kind of be a shield between you and emotional decision making, right?
Yeah, and the best asset that you can ever find is a friend or a colleague who has the worst instincts possible. So when your buddy is euphoric about how much money he's making, you need to be moving away. And when your buddy is thinking, oh, it's a horrible time, that's when you need to be buying. And you need to cultivate that guy, keep in tune with that guy, and find out what he's saying. If you can ever find one of those guys, it's great. But you don't want to ever let him know that that's the role he's serving, because then that will contaminate the data. If you can ever find one of those people, they're just a gem to hold on to.
Just the perfect contrarian indicator, right?
Yeah. In the meantime, you may have to use your own stomach lining as a proxy for that guy.
Okay. All right. Well, Tom, look, I can't thank you enough. Just another super fascinating, valuable discussion. Thanks for putting all the time and effort in to put those charts together for us. Like I said, looking forward to hopefully seeing you at the conference in October, but love to see you in between if indeed your data starts telling you that there's something going on we all need to pay attention to.
Sounds great.
All right. Thanks so much for joining us. Everybody else, thanks so much for watching.